Hello and a very warm welcome to today's video. Now this video is going to be very important to you because this video is going to make sure that you don't pay too much tax. Now if you're not aware, towards the end of this tax year, which finishes at the 5th of April 2024, there's going to be a raft of changes, and if you're not careful and you haven't planned accordingly, you may leave yourself exposed to some additional tax charges, and we don't want that with anyone. So join me on this video. Let's run the VT and let's make sure that you know exactly how we can ensure that you don't overpay on that tax bill. Hello, my name is Aaron Patrick. I am a chartered accountant, a certified UK trainer of fancy new logo, that QuickBooks Chap on the internet, head of accounts here at Boffix, and also your friendly podcaster who goes around each and every Monday morning, 8:30 AM for a podcast called Ask the Accountant. Now in today's video, we're going to be putting the hat back firmly on as Boffix owner, as a chartered accountant, and we're going to be spending time with you to tell you exactly how to make sure that you don't overpay tax. Because there are some big changes, and I think it's really important that you know. See, if you hadn't realised, when the 5th of April comes along, we finish one tax year and we start another. And that means there's going to be a raft of changes that you need to be aware of. And there's stuff that you can do now that means that you can make sure that you make the most out of all the reliefs that are available in this tax year and don't fall foul of them in next tax year. So let's start off with a tax that actually everyone always forgets about, and that is capital gains tax. Now, the idea of capital gains tax is pretty simple. If you buy something, it appreciates massively in value and then go to sell it, then there is a possibility that you have to pay some tax on it. The most simple of examples would be if you had a second home. If you bought a home that you were looking to rent out, or holiday home, or a house of some description, a building of some description, and it was your second one, then if you bought it at a low price and sold it for a high price, then you'd have to pay capital gains on that gain that you make against it. Now there's loads of different calculations and it's not really for this video, but ultimately just be aware that if you go and buy something and then sell it, and there's a potential for tax to come along. Some other examples of that could be cryptocurrency, could be stocks and shares, could be your favorite Pokemon card that you've bought, got it graded, then sold it at a huge profit later down the line. Those items like that are stuff that you need to be aware of, and it gets forgotten about really easily. But ultimately for you, the thing that you need to remember is the tax treaty is going to be different when we switch over to the new tax year. So basically from the 6th of April 2024. So what's changing? Well, basically, if we think back only just over a year ago, our annual exemption, which is the amount that you're allowed to earn before you have to pay tax on capital gain, was a massive £12,300. That got slashed in this current tax year to £6,000, and it's going to be slashed even further to £3,000 starting next year. So if you've got a capital gain and you're looking to realise that gain at this point in time, you're probably better off doing it before that change, because at least in this tax year we get £6,000 capital gain and not the £3,000 we get next year. Also, as always, if you've got multiple gains to make, so you've got multiple things to sell, you may be better off selling one in this tax year, one in next tax year, to really maximise those available exceptions. What will also hurt is that actually we're getting a freeze on our income rate bands, which means as your income rises, that's going to be meaning more of that is going to hit those thresholds. And capital gains tax is also affected by those thresholds. So the lower those thresholds are, in this case they're being frozen, so they're going to be maintained low, the more likely you're going to hit those capital gains higher rates. So it might be worthwhile doing some calculations and seeing if it's worthwhile selling those gains in this tax year, not next. There's also some big changes in the world of dividends as well. So for those who don't know, dividends are primarily a source of income for people who own their own limited company. Now, you get paid dividends from investing in the stock market, and that'll be affected as well. But ultimately, most people don't really find that as much of an effect. The big effect, though, is if you own your own limited company. And if you do, you need to be aware that the dividend allowance is going to be cut again. It's going to be cut from what was £3,000, what currently is £1,000, and it's going to be cut to only £500 next year. And what that means is that you're going to be in a position where dividends are going to be significantly more expensive for you when you're taking them out. So if you can, make sure you utilise all of those allowances, try and utilise as much as you possibly can, and try and push as many dividends into the previous tax year as into the next tax year, because ultimately more of it's going to be subject to income tax going forward. It's also going to be a big year for sole traders as well. So if you're currently trading as a sole trader and you don't utilise a 31st of March or 5th of April year end, then some big changes coming your way. It's all in preparation for what's called Making Tax Digital, and it's called the period end reform. And all you really need to know is if you don't have a year end of 31st of March or 5th of April, then expect some calculations and adjustments in this current tax year. Basically, you're going to be forced to become aligned with those particular periods, and that could in some circumstances mean that you're going to be subject to more tax within a current tax year. So, in essence, two of the biggest allowances that we utilise are being cut. Capital gains allowance going from 6,000 to 3,000, and your dividend allowance going from 1,000 to 500. In both circumstances, you do need to do a bit of planning to make sure you're not hit too hard with these changes. Especially coupled with the fact that our limits for our higher rate isn't going up in this tax year, means that we could find a lot more of our clients are going to be subject to that higher rate bracket, which is what we don't want. What we also need to be aware of is if you're a sole trader, just to be careful about what your year end is. And just be mindful that if your year end isn't the 31st of March and the 5th of April, there could be some adverse tax consequences coming your way. Now, if you want to ask questions about this, don't forget to use the comment section below or use our link tree to book a meeting with one of our experts here at Boffix. But ultimately, you just need to be aware of the changes that are coming. Knowing that the changes are here means that you can plan ahead, and that's what effective tax planning is all about. So have a chat with us or leave a comment. And if you want more advice like this, don't forget to use that like button, use that subscription button, and make sure that you're subscribed to our channel to make sure that you don't miss any changes coming forward. My name's been Patrick. As always, this video has been an absolute pleasure to do for you, and I hope we'll see you in the next video. Bye for now.